Take us in pledge.
All right.
Okay.
I'm honored. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
All right. Is there a motion to approve the land board meeting minutes, previous minutes?
So moved.
Second. Any discussion? All those in favor?
Aye.
Aye. Opposed? Motion carries. Joe, you're up. Operations.
Thank you. Good morning, Governor. Good morning, board members. Welcome, Superintendent, your first meeting. We're glad to have you. Thank you. Congratulations. Thank you. Glad to be here. President and Attorney General Wrigley are traveling, so they'll be joining as remote. All right, I'll move on to my commissioner's report. I'm going to not spend a lot of time on these initial reports because we have a lot of to get to. So my commissioner's report, just a couple quick updates. We did present to the cash management board on November 14th, just giving them an update and an overview of our cash management processes. And did attend the Legislative Audit Review Committee on the 9th of December. So a couple days ago, they did get a presentation on our audit. There were no questions or concerns, so we were happy about that. And then on the HR side, we did hire our new revenue compliance director. His name is Lee Jacobs. He started December 1st, and he is here. I'll have him do a brief introduction. Lee, do you want to just...
Morning, Governor, members of the board. As Commissioner Herringer said, my name is Lee Jacobs. Started December 1st. It's kind of familiar territory for me. I had done a very similar job on the federal side, doing federal royalty audit here in North Dakota. That was a decade ago, and I have to tell you, things haven't changed much. It's really been kind of a walk down memory lane. There's a lot of similar issues, the river and those types of things that you've all been dealing with. So I really just wanted to thank this board and thank you, Governor Armstrong, for the opportunity to serve. I'm really looking forward to it.
Welcome.
All right, thank you, Lee. I'll move on to the financial dashboard now. On page 3, you can see that now that we have our audited financials done and we presented them, we can present the final number for the fiscal year ending 25. Schools Trust Fund just under $8 billion. That is very nice growth year over year from about $7 billion last year at the same time. So almost $1 billion of growth with Common Schools Trust Fund, which was just great. You can see the distribution percentage. We kind of did the calculation again with the new student numbers that were published for the fall. Still around 24% of the share of the state share of the funding that the Common School Trust Fund provides. And then I'm going to skip down to the SIF balance on page 6. Well, I'll hit page 5 real quick. The revenues for the Common Schools Trust Fund, you can see that we have another really good green bar there is the investment return. So another really strong year for the investments of about $800 million on the total investment return there. So page 6, the SIF account at the end of the fiscal year, it had about $1.7 billion in it. Obviously, that's the peak where it spends down now. And so when we get the more recent numbers, we'll show those coming through after the following months here. We'll show that starting to spend down now. So, that's just the balance. That's the uncommitted balance that we report separately. So, and then you can see on page 7 and 8, 7 is the revenues. You can see that we have had really strong revenues to a SIP there. Another good year with the all the tax waterfall, the mineral revenue, and even the investment income is another strong year for us. So able to get a little bit better return with the interest rates being a little higher now. So, and then page 8 is the new tax waterfall that you can see now. SIF is at the very bottom. In the prior biennium, there was a tranche where SIF received some funds early. Has to go through all the other buckets. So we'll receive money into SIF later in the biennium than the previous biennium. Any questions on those? Oh, and then we'll have one more. The last page is our total assets. We have the new mineral valuation in there, $2.177 billion, which we'll hear more on later from Mineral Tracker. So we're looking at about 11.4 billion total assets under the land board management. So with an estimate there. Any questions? All right. The next one is the biennial report, and this is more just yeah, go ahead.
So on the new waterfall, have you guys done any projections out yet? Or is it just too early?
No, we haven't. I think that might actually be more of a OMB and treasurer thing too. So all right. For the biennial report, this is something that we're one of the agencies that's required to do this. It was due December 1st. So we just completed it. And this is more just for your information. I don't think we need to go through it. A lot of this information we presented over the last, 2 years, because it's the 23-25 biennial report. So I just wanted to put it out there. It's a lot of good information. The team put a lot of work into it. So I just wanted to put it out there for everybody to see. And if there are any questions, I'd be happy to try to answer them now. All right. Seeing none, we'll go on to the Surface Division report. I'm going to ask Joseph Stegmiller, our Surface Director, to come up and do that briefly.
Good morning, Governor Armstrong and board members. Today for the surface report, first up we have our encumbrances that we have issued in October and November. And these are going to be anything from oil and gas pipelines to electric transmission lines. October we had 15 for revenue of a little over 300,000. November we had 14 for about 160,000. I will say that currently we're at the second highest yearly revenue for encumbrances. The current highest is 2014 during the height of the boom. There's a chance that we might get the highest, but typically, with the holidays coming up, it's kind of gets slower towards the end of December. So even second highest is still good.
What were those numbers, Joseph?
In 2014, it was about 2.6 million for the year. Currently, we're at around 6 million. So just a shade under. But we'll have those full numbers probably in January. Next up, we have our summary for the fall auctions. So this is when we have our large agricultural auctions in the fall. Just to highlight, we had $2.5 million of revenue. Highest we had for pasture was $70 per acre. That's about double what fair market value is. So there was some good competition. Highest revenue county was Kidder at 267,000.
This maps total revenue, not revenue per acre.
Total revenue, correct. Total revenue, not revenue per acre, hasn't been normalized. If it was revenue per acre, what you would see is just kind of a stepping stone of, lower amount in the west to upper in the east. Going on to the next slide. We kind of, right here, we have a comparison between the 5-year lease cycles. So our leases are 5 years. So every 5 years, we're auctioning off the same tracts of land. So if we compare it to 2015, 2020, you can see in the total amount received, 2015, we had about 1.8 million, 2020, 2.3 million, in 2025, about 2.6 million. So it has been steadily increasing. With that, I'll take any questions. If no questions,
Perfect, thanks.
that was it.
Thanks, Joseph. And I'm gonna go back to I skipped over item 2B there. We do have Ide Bailey here to present on our audit. So Jared Mack from Ide Bailey, if you want to do that for us. Sure.
Good morning, Governor, members of the board. My name is Jared Mack. I'm an audit partner with Ide Bailey. Here to present the results of the financial statement audit of the department for the fiscal year ended June 30th, 2025. I won't really dig into the numbers because they've been presented by Joe and Peggy and their team previously, but as a result of the audit, similar to years past, we issued an unmodified opinion over these financial statements prepared by management, which is the cleanest opinion that a CPA firm or an auditor can provide. Basically, we're saying, in our opinion, there's no material misstatements or omissions in these financial statements. They're materially correct. We did not have any findings, any written findings, material weaknesses, or significant deficiencies in internal control identified. There were none in the prior either that needed corrective action. There were no instances of material non-compliance identified. So really about as clean of an audit as yeah, Joe and Peggy and their team members were very cooperative again. As a result of our team being out there, it went fairly smooth. We issued before the deadline of October 31st, so no hiccups or anything along the way. I guess that concludes the presentation I have on the audit. Would welcome any questions anyone may have.
We like clean audits. Any questions?
Laid it out well. Thank you, Jared.
Yeah, thank you.
All right, I will move now down to 3B, our minerals division report. That is on 27. This is our monthly royalties. You can see that we've been in the mid millions for the past several months, and we had another year right around there. Year to date, fiscal year to date, we're just a little bit behind last year, 143 million versus the 157. And if you go to the next slide, 28, you can see that, you know, the black line is the price that has been trending down a little bit, and that's really mostly related to that. The volume has been pretty steady. Joel from Mineral Tracker obviously is going to do a deep dive in all what's going on in the development of the industry later on. So, and any questions on the royalty reports? Okay. Now we'll hand it out to Susan with unclaimed property. Summerfield, our unclaimed property division director.
Morning, Governor Armstrong, members of the board.
Great.
How's handing out free checks?
Well,
Free.
we
Not free. Unsolicited.
unsolicited, yes, we actually mailed last Friday 142 checks totaling $57,609. About. So what happened with our population is we picked that sweet spot between $50 and $1,000, and about half of the ones that were presented to us were greater than 1,000. So we sent out probably another 100 claim forms saying, we know this is yours, but we need some additional documentation. So some of those were relatively large. One of them was about $250,000 that we were able to identify and say, here, just send us the documentation. So then it's a waiting game.
Sure.
I did request a second population about the same, with the same parameters to be sent to us. So we're working on batch number 2 already. So very exciting stuff. We also had, go back to the slides. We have really a lot of stuff going on in unclaimed property right now. For the month of October, we paid 442 claims for about about $476,000. But really what happens in October is our deadline for the holders to report. So the money coming in, we had just over $23 million come in October alone, which is a record. I thought 20 million last October was pretty fantastic, but we're $3 million ahead of that this year. So we got all those processed. We're ready to return that money. For the month of November, our focus was claims. We paid 994 claims with $912,482 returned to owners. A lot of that was generated from the press release that we put out regarding the unsolicited checks. So what happens is those 994 claims were primarily the ones that fast tracked, meaning the data that the claimant puts in matches our database enough so that we don't have to put our eyes on it. So in addition to that 994 claims, we have probably 750 sitting in our queue that we have to look at. And when they come in with documentation, they're time consuming because they're estate claims and business claims and those sorts of things that get real tricky.
What type of documentation are you reviewing to match this up?
The first thing we have to do is identify the claimant. So we need a photo ID and something that shows their social. And then we have to make sure that the right person is claiming the property. And when we have similar names, sometimes we get a little pushback, that I'm the only John Smith in Fargo. Are you? So then so the first thing we look for is a social match, which we only get about 25% reported to us. If we don't have that, then we look at the address, and then they have to provide something that matches the address. If we don't have that, then we ask for proof that they did business with the holder that reported it. Sometimes there's a lot of back and forth. But
And if it gets to be an estate claim, it can be more complex because then you have to make sure they're entitled to receive from the estate. So
yep, we need a death certificate and something that shows the claimant has the authority to act on behalf of the deceased. So lots going on in unclaimed property. We also just finished last weekend our rounds of Pride of Dakota holiday showcases. So those are always fun to get out there and be in person and interact with the constituents. They seem to appreciate that. We're looking at.
we went to all of them, right?
Yep. Dickinson, Minot, Grand Forks, Fargo, Bismarck. In total, we had 182 claims generated from that for just over $100,000. I think that's normally we would report that as just the show numbers, and then add the word of mouth because lots of folks go home and say, "Hey, I saw your name. You should," that sort of thing. But with the press release that went out, and we took those numbers out of there because it would have been super skewed with all of the press that generated the tremendous amount of traffic to our website. So that's what's going on in
Okay.
unclaimed property.
Any questions for Susan?
Been busy.
Crazy.
Yeah.
Yes.
All right, we'll move on to investments and we'll ask our Chief Investment Officer, Frank Mihail, to come on up and give the investment report, and then he'll also move off to RDK.
Thank you. Good morning, Governor Armstrong, members of the board. Hey, everyone. We'll start investments on slide 31. And before I jump into the dashboard, I'll give you some updates on the portfolio with regard to some of the recommendations we've made in the last quarter. You recall for the benefit of Superintendent Bachmeyer, and congrats again and welcome. Recommended 100 million to Cloud Capital, which is a digital infrastructure data center fund. We did the goal and finish that, and so we're waiting for them to make that capital call to get that money to work. Last board meeting, we also brought recommendation to venture capital fund. The team is through on that. Okay. So we're legal on the Andreessen Horowitz and should have that wrapped up by the end of the year. As an update for what's coming in the new year, we will be bringing a real estate recommendation. We don't have any, but in January, I have a real estate recommendation. Jumping into the dashboards, this as a reminder, every month we'll have this dashboard, which is what we'll call like a flash report. It's the most recent but numbers that we're only getting the liquid numbers coming through, so they're very preliminary. And then every quarter, RBK will come out with the quarterly reports. Those are on a quarter lag. There's more numbers with private markets rolling through those. So today you see two different snapshots, 2 different time periods. This dashboard is as of October 31st. And then when I hand it to Jen to go over the quarterly reports, that'll be as of September. So as of October 31, the portfolio is at about 8.5 billion and continues to climb to new highs. On slide 32 shows the asset allocation versus our targets. And the way to read that chart is the red squares on each end is the sort of target ranges. Min and max range. The blue dot is where we are today. So you can see every asset class is in range except for the public credit, which is essentially our bond portfolio, our most liquid part of the portfolio. And the vision there over the next year or two is as we make more commitments to private equity and infrastructure where we're underweight, we'll use that liquid bond portfolio to fund those capital calls and bond. On slide 33 shows the flash performance report as of October 31st. So you can see that the international public equity continues to lead the way, followed by West stocks, and private credit and hedge funds also putting up significant double-digit returns for the portfolio. Any questions so far on those first 3 slides with allocation and performance? Now,
Asked Joe yesterday, but I'd be curious just to hear from you, just to make sure I'm fully comprehending. Trying to look at the minutes and the previous agendas. It seemed like there was a change August around our sort of asset allocation strategy.
Yep.
What was sort of the overarching goal of those moves?
So, back in around August, we changed the asset allocation. That asset allocation review in our investment policy statement should happen at least every 4 years.
Okay.
We've been seeing, I think the last time was 2 years ago. And the vision there was as an endowment, we have the ability to take more risk. And so we wanted to incrementally move from more income-driven investments like credit and private credit into more growth-driven, including public and private equity.
It seemed like it was a more intentional strategy to get more aggressive.
And so one of the discussions that we had with RBK was is now the right time. It's really hard to time everything, but it really isn't a timing game. It is more of a long-term vision. The capital markets assumptions, what's that go into the analysis, all long-term assumptions for looking for a decade out. Anything I need to suggest?
I would agree. I think that the broad theme, the orientation of the portfolio, if the for a 10% spend every millennium, that leaning into both public and private equity was something that we thought was appropriate. I also think it's important to acknowledge that this portfolio's private markets program is actually relatively young, that you've only been investing in private equity for about 5 years and private credit, not even that long. Sure. And so I think, the initial step into private equity was relatively low compared to other endowment portfolios. And so putting some capital to work over the last 5 years was part of that. But then leaning into the growth orientation will help move the private equity over the long term.
So then on slide 34 shows our uncalled commitments. You can see the bulk of it coming from that private equity portfolio. Within the private markets asset classes, private equity has been slow to get that money. So we will have some more private equity recommendations in the new year as well. And then the last slide of the dashboard here is the liquidity. That doesn't really change too much month to month, but it just shows how liquid the portfolio is. Yeah, I guess any other questions for me before I hand it to Jen for the September 30 performance? All right, Jen, take it away.
Fantastic. Good morning, Governor, members of the board. Great to be with you this morning. RBK's performance report on page, I think it's 38. And this report is as of September 30th, so a little bit dated relative to the numbers that Frank walked through. But the first page in the performance report gives you a sense of the market backdrop for the third quarter. It was certainly another strong quarter for risk assets. You saw a continued upward trend in equities in particular following the early April volatility that we saw in the capital markets. You saw strong returns in the second quarter, and the third quarter was largely a continuation of that for public equities. Markets benefited from expectations for a more accommodative monetary policy, that if you looked at the probability of a Fed rate cut in September, that markets were largely anticipating that the Fed would lower rates at their September meeting. And that was the case. The Fed lowered interest rates 0.25% at their September meeting, and citing largely weakness in the labor market. You saw the August payrolls report was significantly below expectation. You also looked at the job creation report, the trailing 12 months that ended in March. You saw pretty meaningful revision downward in job creation. And so, the Fed's doing price stability and full employment. They're kind of in an interesting and unique situation right now with concerns over labor market weakness, but also inflation sitting above the 2% target. And so, the committee is charged with evaluating the data, meeting to meeting, and making decisions on how to manage monetary policy to fulfill that dual objective. And so labor market weakness was kind of in key focus at the September meeting. You followed the Fed meetings in October, and yesterday the Fed lowered its benchmark rate another quarter point in October, and did so yesterday. I think largely anticipating. I think interestingly, yesterday the message was, you saw 3 members dissent. I think even more interestingly, when you look into the 3 members who dissented, it actually was not a uniform dissent in terms of agreement on should we hold rates steady or reduce further. That you saw 2 members have a view that rates should be held constant, and one was supportive of a larger cut than 25 basis points. So some discussion and not a uniform necessarily opinion on the direction for monetary policy. But the language that came out of the press conference was was very much that rate cuts are not a foregone conclusion next year, and that the expectations for rate cuts are likely to be much lower, and the potential for putting any rate cuts on hold is higher into 26. And I think that the dot plot for the median Fed member has one cut next year and one cut into 2027. So, an interesting backdrop certainly for the Fed. Unemployment ended the quarter at 4.4%, so inched up just a little bit from lows earlier in the year. Fixed income, you saw yields drop over the course of the quarter. That's against the backdrop of expectations for lower rates going forward. So if you look at the Treasury yield curve, which is in the middle on the right-hand side of page 38, the green line shows you where the Treasury yield curve ended September. So you can see the shift down in the bulk of the curve, but most of that is on the left. The more visible part, yields moving down on the shorter end of the curve. Stocks, both U.S. and non-U.S. stocks had a strong quarter. U.S. equities outperformed non-U.S. equities for the quarter. Large cap stocks were up a little more than 8%. Small cap up a little more than 12%. I think interestingly, if you were to dig into what did well in the small cap universe, you saw a pretty strong low quality rally. So companies with heavier debt loads did much better than healthier companies with stronger balance sheets. I think the prospect of slightly cheaper debt financing for those companies saw those stocks trade up to a much higher degree than higher quality companies. Non-U.S. markets had another strong quarter, up for developed markets up 4.8%, emerging markets up a little more than 10.5%. And then the fixed income landscape up 2% for the quarter. It's been a strong year for public credit, the investment grade bond market up a little more than 6% through September 30th. So certainly a strong year so far, 9 months ending September for the capital markets, and see how that has benefited the investment portfolio here in a couple of minutes. But maybe I'll pause there and see if I can answer questions on market environment. The one topical slide we added to the quarterly performance report this year is on page 39. And it compares the Fed dot plot to forward the forward 10-year curve. And I think the main takeaway here is looking at expectations from the Fed dot plot for where short-term rates are likely to go, or where the Fed members expect the short-term benchmark rate to go, versus where markets expect the 10-year Treasury to go. And this is not a projection on where rates are likely to go, but it is an assessment that there is a disconnect between where short-term rates are likely to go and where markets expect longer-term rates to go. Markets expect Treasury yields to actually move up over the longer portion of the curve, despite projections for shorter-term rates to come down a little bit incrementally over the next couple of years. So an interesting disconnect in where short-term rates are likely to go, or members expect to go, and where the markets are assuming longer-term rates will go.
Interesting is an interesting word.
Yes. There have been lots of publications with lots of data looking at, the historical relationship typically is when you see the Fed start cutting, you will also start to see longer term rates go down. And you actually have not seen that to be the case. Over the last year, you've seen the long end of the Treasury curve move up. And if you look at the Treasury yield curve on page 38, the yellow line is a year ago, and the green and blue line are this quarter and last quarter. And so you can see that the 20 and the 30 year have shifted up above where longer term rates were. So one kind of data point that we thought was useful to include this quarter. Then on page 41, Frank talked a little bit about the current portfolio positioning. So this snapshot does reflect the updated asset allocation policy target, leaning into both public and private equity and reflecting the reduction in target to fixed income. I think it's important to acknowledge and understand that the private equity program will take time to put that capital to work. You're meaningfully underweight now, and that's okay. That's a reflection of increasing the target a couple of months ago. But we do think it is prudent to have broad diversification across vintage years. So it will be a multi-year process to invest capital with a series of private equity managers. That this is a target that's not going to increase dramatically in any given year, and having a well-diversified private equity program is appropriate. So that's something the board members are likely to see over a couple of years, but the hope and the goal is to move it closer to target over a series of years. And then on page 42, this is the first quarter in the new fiscal year, so only the third calendar quarter of 2025, but breaks down the contribution to the third quarter return. So the portfolio was up 3.47% in Q3. The vast majority of that contribution was from public equity, roughly equal parts U.S. and non-U.S. equity, but fixed income has had a strong year as well. Public and private credit portfolios have added value. So broad contributions from all of the asset classes to the portfolio's return for the quarter. And then if we move to page 43, this is by asset class for the portfolio. So I mentioned up 3.47% for the third quarter. Calendar year to date, the portfolio is up 10.65%. That is roughly in line with both of your policy benchmarks. Recall when the asset allocation was reviewed and investment policy changes were presented, one of the additions to the policy was the inclusion of dynamic benchmarking, and we label that as the actual allocation index. So the actual allocation index takes each of the asset classes here, uses the broad index for comparison. So for US equity, that's the Russell 3000. For non-US, it's the ACWI ex-US, and says, based on the current weights, how have our managers added value above the broad asset class benchmarks? The target allocation index assumes you are perfectly invested at your target portfolio each month, which isn't necessarily realistic. So this tries to negate some of the impact of being away from your target allocation, and says, how have your managers done? How have the structures that are in place in each asset class done compared to the broad asset class benchmarks? And then the portfolio is up 11% over the last year, and you've outperformed both of those benchmarks by about 90 basis points. Questions on the benchmarking addition? US equity is probably the one asset class that I would highlight here, up 6.94% for the quarter and 11.44% for the calendar year. Recall the structure for US equity and non-US equity is about 50% passive and 50% in extension strategies. So managers that can buy both long and short stocks. So they're higher octane, higher tracking error strategies. For US equity, the biggest driver of underperformance has been Jacobs Levy. They've had a tough year. I think it's want to acknowledge that they were, you invested in Jacobs Levy 2 years ago. They've struggled a little bit over the last 2 years. They're also one that I think we expect full evaluation over a full market cycle. And so periods of performance where they lag to a meaningful degree are possible. They are somebody that we continue to have a high degree of conviction in. I think it's just appropriate to acknowledge they've only been in the portfolio for 2 years. Their portfolio positioning has been a headwind. They're a little bit more focused on quality. They're a little bit smaller in terms of capitalization. So those two kind of factors for at least for the third quarter were pretty big headwinds for their performance, but not someone that we have concerns about long term. Your international equity managers have actually done a really nice job year to date and over the last 12 months, up 29.25%. 9 months ending September 30th. You have 2 active managers there, complemented with passive allocation. Your active managers have done a really nice job so far this year. Private equity, we include the private equity comparison here because the cash flows and the valuations impact the total fund performance. This isn't necessarily the most appropriate way to think about the success of a private equity program. Each quarterly period here is treated exactly the same as any other quarterly period, and you're evaluating the success of a private equity program over a much longer period of time. And then fixed income broken down into public credit, which is passively managed, tracks the U.S. aggregate bond index, and your private credit portfolio, which we expect to outperform the leverage loan index by 1.5% over the long term. Well, we're just past the 3-year mark for the private credit program. The managers that are in place have continued to do that over the 3-year period. And then the diversifying asset classes are on page 44. Absolute return is your hedge fund portfolio, up 2.33% for the quarter, 7.5% for the calendar year. You have a very high quality mix of hedge funds with a variety of different strategies, all of whom have done well. I think I mentioned this, at the September meeting, that these results are nice to see. I think it would also temper expectations that even if the returns for the hedge fund portfolio come down some, RBK's expectation is this asset class provides diversification to stocks and bonds, that this is not an allocation we would ever expect to keep up with public equity. That the diversification to traditional stocks and bonds is what you're going for with the hedge fund portfolio. And then for real estate, up 14, so to speak.
Yeah.
For the real estate portfolio, up 14 basis points, I would qualify that by saying the allocation to IDR, which is the passive allocation, actually is not updated as of September 30th. So this doesn't reflect all of the valuations available. This number is likely to come up a little bit when that valuation mark comes in. But you have seen some stabilization in the commercial property markets over the last year or so. And then private infrastructure, the portfolio is a mix of evergreen or open-ended funds and closed-end funds. And for the year up a little more than 6.6%, and over the last 12 months, about 8.5%. Recall the infrastructure benchmark that we talked about along with the policy is reflective here. This benchmark actually, the quarterly return comes out at a full quarter lag. So it's not likely we'll ever see the current quarter's data against a current quarter benchmark return, but it will be more reflective of appropriate performance comparison over longer time periods. And I will stop there with prepared remarks. What questions can I answer from you more members?
So the net of that on when we're talking about private infrastructures, focus on calendar year to date is going to be a more helpful metric to look at as opposed to given the data issues on a quarterly basis.
Correct, or even out over 3 to 5 years, I think would be. And this index is actually a new launch by Wilshire that launched with 3 years of data. They just launched over the summer, and so they backfilled with 3 years of data. So this is a combination of 6 different open-ended infrastructure funds. The prior benchmark was listed infrastructure, some publicly traded infrastructure securities. You see equity-like volatility, and your infrastructure portfolio is privately held. So you see a lot of meaningful dispersion in the index return versus the portfolio return. So this was something that we were very positive on having a more appropriate benchmarking comparison for private infrastructure portfolio.
So this report, there's about, I would say, 85% of the data is there. There's still rolling in. It'll probably take about another month for all that data to come in. And then once it comes in, post it to the website once the report's finalized.
Any questions? Thank you.
Thank you. All right, we'll move on to item 5D in the agenda. This is the administrative code update. If you recall, we had a first reading a couple months ago. We did have a public hearing in November on it, and we had some public comments and made a few, nothing major, but I'll hand it out to involve our general counsel to do that with you and make recommendations.
Good morning, Chairman, members of the board, and welcome, Superintendent. Good to have you here. Thank you. Back in September, if you recall, we went through kind of a first reading of the proposed rules. After that, we held a hearing, like Joe said, on November 4th here at the Capitol. For public comment, we had one verbal comment at that hearing, basically in support of a written comment that was then submitted. We held the comment period open until November 17th, allowing people to call in. They could write email, they could leave voicemail, they could mail a letter until November 17th. And then what we did is we went back and looked at the comments and reviewed them and discussed with Joe and the staff about if there's any recommendations we should bring as a result of those comments. So I'm just going to briefly go through the comments that begin on page 66 of the board packet. Part of the changes that were made were to the construction aggregate part of the rules. There was positive comment given for support of making the royalties payable each year rather than per month. That was reduce the administrative expense for both the department staff as well as the construction aggregate companies who were mining. And the other positive feedback we got was changing the amounts from per yard measurements and bids to a per ton. And what that did is that allowed alignment with how the industry actually mines and measures those amounts that are removed. So two written comments on that, both in support of the construction aggregate changes. One of the other things highlighted in a different comment was the movement of, or the focus rather, of the notice of lease auctions are required under the rules. When we hold a lease auction, we go ahead and publish and let people know, the public know that we're going to hold the lease auction. Previously, we were publishing the lease auction notice on the website as well as the local newspapers where the property that is up for auction is being held. We felt that a focus on the website communicating those lease auctions was more effective for staff time and for cost. So the proposed change was that we removed the requirement that those lease auctions notices be published in the local newspapers. And the North Dakota Newspapers Association was opposed to that. Our recommendation is to stick with the website publication with the idea that the vendor that we use, Efficient Markets, for the lease auction also does marketing, so to speak, on our behalf and letting potential bidders know that there's an auction coming up. Lastly, there were some changes that were proposed to encumbrances. Look on page 67, we have a summarization of the comments submitted for those changes. There's support for the streamlining of the permit process and of the surveying, particularly the surveying application process, and move towards electronic applications. I think it makes it easier for everybody, staff and the general public involved in submitting those applications. There were some concerns over the commissioner's discretion to deny applications. We discussed with the commenter, and we decided as a staff to recommend we remove those parts of the rules where the commissioner has sole discretion to deny those applications. And then the other concern was the requirement that was inserted to, as a default, the requirement that all infrastructure be removed from the premises unless commissioner permission is granted. And we felt that was probably better to handle on a case-by-case basis rather than making the removal the default. So we recommend removing that part of that section of the rules as well. So that pause there for any questions on comments or comment.
Page 73, number 7. Just striking out with the United States is.
Yeah. So we had thought initially said land exchange with the United States. That largely pertains to what we thought was a land exchange with the United States. But there's several avenues within statute that the department can exchange.
So
land
this
with
just
other
makes it
agencies.
any trust, right?
The idea is to apply it to any exchange.
Okay.
Rather than just the United States. And that was the last recommended change, just striking that specific update for the United States. The next steps, I guess, are we're going to, if the board approves the rules as they appear in the packet today, we're going to send those over to the Office of the Attorney General for review of legality and submit the packet to. So what we're looking at is a potential effective date of April 1st, hopefully getting on the agenda with the Administrative Rules Committee when they hold their spring meeting, likely in March of this coming year. With that, any questions?
Any questions?
Fundamentally, the board staff felt like there was a vacuum in the administrative code space that necessitated this just overarching project. I'm coming in late and I realize we're starting on the goal line.
Most of the changes were to clean up things, to make them more efficient, more user-friendly. Not a whole lot. The substantive changes were mostly some of the ones that were commented on that have been flagged, but it was mostly to try to make them more user-friendly, more readable, more efficient, restructure them a little bit. There weren't a whole lot of substantive. I don't know, James, if you have any further comments on that.
I'll just add the background. A lot of the rules, I know you'll see in the packet a substantial number of pages. But a lot of the rules that we touched were first enacted in 2020 timeframe.
Sure.
And this is on the first time that we really did a whole holistic look at it and said, how can we improve it for readability and clarity?
Sure.
So a lot of the changes you'll see are just shifting some things around and restructuring how the rules read.
A lot of it's just specific, adding more definitions and correcting, like, there's one about how a minor would claim something.
Sure. And there were some duplicative areas where you said the same thing in two different areas. So just get rid of one of them and say it once. So
What is our recurring expense for posting this stuff in the newspaper?
Chris, do you want to talk about that a little bit?
Yeah. Governor Armstrong, members of the board.
And you can just provide your general. I'm
So-
still not doing you too, but you.
Yeah, I think it depends, because we don't know which newspaper we're gonna have to publish in because it's by the county and, but I think it's, I asked staff that, or administrative staff that does that. Would be a lot of time saved, but I think for a dollar amount, I think for all auctions, it's probably $30,000 to $40,000 a year, something like that. For mineral auctions, probably half of that. I don't know, with my engagement with our stakeholders, they're really getting their information through efficient markets and following our publications. We do email blast notifications for them. So they know there's upcoming auctions, but more often than not, they're the ones nominating these tracts anyway. So efficiency is saving our administrative staff time, and we just don't see people that get the local newspaper that are coming in bidding on oil and gas auctions. This is really the only area that we would change. The
Surface for the oil.
surface auctions are mandated.
Yep.
Because obviously it's dealing with the surface, so it's a little more important. But it's up to you guys.
How many of these are weeklies?
Papers?
Yeah.
Sure.
Most of them.
I would imagine this gets the admin rules committee. This will be a conversation for sure.
Yes. We anticipate that. I think it's preference, like I said, do we see a benefit? Probably minimal for gas auctions. For surface, they do, but that's something like I said. So
Well, for surface, Joseph, correct me if that.
Correct, they're mandated by the Constitution.
Right.
Correct.
so that's
That's
nice.
nice.
And in those auctions, you have a lot more local folks,
Right.
local ranchers and the like that bid on those auctions. In this case, it's not necessarily local folks who are doing the bidding on one.
And this is our recommendation. If the board has additional thoughts, we can certainly make some adjustments to it. So it's,
I'm just trying to see what's efficient and save money and time, make sure we're not spending money where we're not seeing a lot of benefit.
Any questions? I'll turn it back to Joe for the recommendation.
any other questions or comments from the board?
No question from me. I just want to thank the staff for how much time and diligence they put into this. I know admin rules will have hearings on this as well and go through it, but I think it makes sense to me.
Great, thank you. Okay, so if you go to page 65, the recommendation is that the motion be that the board authorize the commissioner to submit the proposed administrative rules to the Office of the Attorney General for rules opinion and the Legislative Administrative Rules Committee for final approval and enactment.
So moved.
Just a second.
Second.
Any discussion? Roll call.
Secretary Howell.
Yes.
Superintendent Bachmeyer.
Yes.
Treasurer Beadle.
Yes.
Governor Armstrong.
Yes.
Thank you.
Great, thank you, James. All right, we're going to move on to item 5B in the agenda now. This is our presentation from Mineral Tracker on the annual valuation. This is something we've been doing for several years. What year did we start it?
2020.
2020. And we found it to be a very useful thing for both the staff and the board, and hopefully the public as well. So, Joel Brown from Mineral Tracker, do you want to give us your colleague?
Sure. Of course. Mr. Governor, members of the board, thank you for having me. It's always a pleasure to be here. With me today is Captain Grimsrud, who leads our Mineral and Land Services team at First International Bank and Trust, which is synonymous with Mineral Tracker. So I know that I had said previously that it might be more convenient if I could share from my own screen, but in the name of just continuing to move things along, if it's more convenient to share from the PDF that I've been rolling through, that would be just fine. And I can just.
Lynn wants to do here.
Okay.
Yep, she's got it.
Excellent. Okay, perfect. Mr. Governor, members of the board, as Commissioner Herringer mentioned, this is actually the 6th year that we've done this analysis for the North Dakota Department of Trust Lands. Every year, this represents for us and our team the largest single project that we work on. It encompasses the largest mineral position across the state of North Dakota and holds an interest in about half of the wells drilled in western North Dakota. So if we jump to the first slide, the next slide rather. Today in our presentation, we are going to spend a little bit of time both reviewing how we go about the methodology and appraising the state's mineral ownership, talk about changes from prior years, and then towards the end of the presentation, just because of the granular nature of how we approach this analysis, we always get great insights into what's going on in the industry. And so we've got a few slides at the end that are highlighting some trends that we found of interest, and hopefully you do too. So to start with an overview of how we conduct this analysis, on the right side of the screen, you'll see a map which shows all of the state's mineral ownership in yellow and in blue. So yellow and blue tracts, yellow representing unleased mineral interest tracts and blue representing leased mineral tracts. The green, located in the western part of the state, represents all of the horizontal well bores of the wells in which the state holds royalty interest. So like I had mentioned prior, about half of the wells drilled in the state. For the productive areas of the basin, we perform an in-depth reserves analysis. So we're looking at each individual well, we're looking at each spacing unit and identifying how many wells could be drilled in this spacing unit within the future. What is expected production from those future wells based on the trends of production in the area. Roll all of that into a reserves database and then generate from that a forecast of royalty income for the state. We discount that forecasted royalty back to a current value today based on what we believe a willing buyer and a willing seller would pay at various discounting rates and assumptions. For the mineral interests that are outside of the productive area of the basin, we utilize a market approach. And the reason we do this, of course, is because we don't have a sound reserve space to be able to forecast income from these tracts. So looking at lease auction sales and identifying the average bonuses paid within a given area and then applying that through a 2.5 times multiplier to value the tracts that fall outside of the productive area of the Bakken. The majority of the focus winds up being on the reserves portion of this, and that is, of course, where the majority of the value is coming from as well. As Commissioner Herringer mentioned earlier, the results of our valuation this year came in at approximately 2.2 billion. I'll round to 2.2 for the sake of simplification. If we move on to the next slide, this provides a far more detailed breakdown of the valuation, and I won't go through all the details included in this table. First, I want to highlight the acronyms across the top and give a little bit of definition of these. PDP, or Proved Developed Producing, represents any producing wells in which the state holds for royalty interest. PDSI, or Proved Developed Shut In, are wells that have been producing but have been shut in very often for operational reasons, they need to be worked over, they need to be returned to production. PDNP represents proved developed non-producing, which are wells that have been drilled but not yet completed. So another word for these would be DUCs or waiting on completion wells. And then PUD, PROB, and POS each represent proven, probable, and possible undeveloped reserves. These are the reserves that are associated with the future ability to drill wells that do not currently exist. So if we go into a given area and see that a single well has been drilled across a 2-mile spacing unit, but know that operators in this area are drilling 5 Bakken wells and 5 Three Forks wells, we're forecasting the development of those future wells, and those would fall into the PUD, PROB, and possible categories. On the table, I did highlight just two numbers, the bottommost number representing the total valuation. On the far right column, I also highlighted the undiscounted cash flow. So like I had mentioned in the income approach, we create a cash flow forecast for the state and then discount that back to a present value today. That undiscounted cash flow, meaning just what we're expecting the royalties to generate based on this analysis, comes in at about $8.4 billion over the lifetime of the reserves. I wanted to make one correction to this slide, because in the bottom left of this slide, I highlight changes from the prior year. We did see PDP, or the producing wells, increase by 454 wells. It says here that both the PDNP, or the DUC wells, and the shut-in wells both decreased. Those both actually increased by those amounts rather than decreased. So partially because we've seen oil prices come down, we're seeing some operators shutting wells in or possibly not returning wells to production as early as they would have in a higher oil price environment. And we're seeing some operators slow down a little bit in moving a completion crew out after the wells have been drilled. On the next slide, we illustrate the trends in this valuation that we've done each year going back to 2020.
Can I stop you for
Of
one
course, yeah,
minute?
please.
Is it a assumption on the, or what's the criteria that distinguishes proved from probable from possible?
Excellent question, Mr. Superintendent. The distinction in this analysis is largely economic.
Okay.
So we know that reserves in these areas are very likely to exist because we've got offset wells that are producing.
Sure.
However, in some of these cases, the offset wells that are producing don't necessarily indicate that it would result in an economic well if drilled today. So the probable and possible represent less likely economic success rates for the operators if they do come out and drill these wells, whereas PUD, the proved undeveloped, represents a likely economic success rate.
And I'm assuming both infield and adjacent.
Yes, correct. Yes.
Since we're there, when you talk about shut-ins, so you got 584 over the course of what? What's I get the going forward. What's the going back on shut-ins? Is that over the last, since when? Where's that 584 number?
508, Mr. Governor, 584 represents the number of wells that were shut in at the point in time that we conducted this analysis. And so what that would mean is that they had not produced for a minimum of 3 months prior to us doing this analysis.
Through
Some of the, I'm sorry, didn't mean.
Starting when?
Yes, of course. I understand your question now, Mr. Governor. Some of them go back many, many years.
Yeah.
We would still be classifying some of the wells that have been
We didn't
shut.
shut in 584 wells in the last year.
No.
There's a total. We did a snapshot of shut-in wells at this point. Okay, that's
yes. Good clarification. Some of these wells have been shut in for a number of wells or for a number of years, but have not been permanently plugged and abandoned. Once they would be permanently plugged and abandoned, if they're not going to be returned to production, then we would move them off this list. Okay, thank you for the question.
And it doesn't mean either that the entire, there might be, same wells in the spacing unit that are produced.
Yeah, it's just the fourth bench of the Three Forks.
Yeah.
So on the valuation trends, the point that I want to illustrate here and what I believe the graph shows is that this is largely tied to oil prices. There's a very strong correlation. Ultimately, we do go through each year and update decline curves for every one of these wells, update every element of the analysis. We still find in the end result that very often the correlation to oil prices is really strong. So we saw a 12% decrease in value. We saw a 12% decrease in value from last year. That was largely just related to oil prices. We've seen a lot of really positive things as far as operators reaching into new areas where they hadn't previously been drilling, accelerating development of areas that prior wouldn't have been drilled before, going to 3 and 4 mile laterals. We'll touch on that towards the end of the presentation a little bit. So there have definitely been some positive things that have offset elements of the oil price decline. But we also have to recognize that these reserves are being liquidated, each day as the wells continue to produce, generate royalties. There are less reserves to be produced in the end. Chris had provided me with the June 2024 through June 2020 or July 24 through June 25 royalties generated of about $455 million. On the next slide, staying within the theme of oil price, we utilize, and this was per the mineral valuation policy that was adopted back in 2020, we utilize NYMEX strip pricing, or the New York Mercantile Exchange strip pricing, as our pricing assumption for oil and natural gas. This graph illustrates what that price deck has looked like each year that we've done this analysis. So the dark blue line represents both the historical North Dakota oil prices to the left of the dotted line. To the right of the dotted line is the forecasted North Dakota prices using that NYMEX strip pricing assumption. That was pulled on November 17th of 2025. Each one of the smaller lines represents the price deck that we used in prior analyses. So, if you go as far back as our 2020 valuation, when oil prices were incredibly low, we were the forecast at that point in time would have been an increasing price deck that would eventually level out at sub 50 million or $50 per barrel. Today, the price deck that we're using is largely flat with a small combination of contango and backwardation in the forward curve, and then leveling out sub $60 per barrel for North Dakota realized prices. Go to the next slide. This slide is one that I very much like to highlight. It takes up an entire slide. This is what I would call a production profile for the state's oil production. So what's illustrated here is the monthly net oil production realized by the state. The dark blue represents those PDP wells. So you can see the historic growth prior to the oil boom and through the oil boom, ups and downs as we've seen an oil price decrease in 2015, a very sharp decline in 2020 related to COVID and wells being shut in, and then some periods of growth since then leading up to today. At the dotted line represents the effective date. So everything to the right of the dotted line represents a forecast. You can see the very sharp decline if we were to stop drilling in North Dakota today, how quickly our existing wells would fall off in production, which is why it's incredibly important for the development of the Bakken with wells that start out at very high production rates, but then decline very quickly early in life, that we continue to see regular drilling continue. The light blue represents the drilled uncompleted wells. So there is a nice set of duck wells in inventory that are scheduled to come online relatively near term. And then the kind of mauve color along with the second dark blue and the maroon represent those undeveloped reserves. You can see, and then the line here represents cumulative well count for the state. So you can see, correlating to the production increases, very quick ramp up in the early 2010s, an inflection change and then another inflection change in 2020, where we dropped from typically about 60 rigs drilling across the state to where we've been more recently about 30 rigs. And you can see that we forecast the continued development of these wells until you hit another inflection point beginning about 2035 and continuing to level as,
Hey, Google.
sorry, I'll continue. As we have less productive locations remaining. This aligns fairly well with what I've heard recently coming from Lynn Helms as well, is that we're looking at probably about another 10 years worth of quality Bakken development that's going to lead to a relatively flat production rate for the state overall. And this is fairly analogous to the state's overall production. One piece that is missing from this illustration that we have done some analysis on in the past was what's the possibility of enhanced oil recovery and what does that ultimately add? Because this does not take into account.
This is existing tech.
This is existing.
Straight line projection of production.
Exactly.
Sure.
So
Productivity.
no forecast at this point in time of improving technology. If we did not improve in technology between now and 2035, this is ultimately what we have. We know, of course, from the history of the oil and gas industry that that's not the case. We continually improve. And one of the key pieces of that puzzle today is enhanced oil recovery, which I'm sure you see on the Industrial Commission and a lot of exciting work going on there. If we do add that wedge, and if we were to illustrate that based on the information that we have coming from the EERC and from our analysis, what it effectively illustrates is about another 10 years worth of flat production. And if we have produced today a little over 5 billion barrels of oil across the Bakken Formation between the early 2000s up until today, the estimates are that unlimited enhanced oil recovery, meaning it's not constrained by the ability to get natural gas or get carbon dioxide into the basin, could potentially improve reserves by 3 to 7 billion barrels, which would be effectively a repeat of everything that we've seen to date. So the size of the prize is very significant, but not
without any of the original infrastructure challenges.
On the next slide, I like to place these two back to back to just illustrate the impact of the net present value discounting that we use. So this graph now, very similar to the last graph, but showing on the dark blue line towards the top, the undiscounted cash flow that is resulting from our reserves analysis, and comparing that to the discounted value month over month of each one of those reserve categories. So you can see basically the white space between the top of the wedges and the bottom of the blue line represents the difference between the 8.4 billion and the 2.8 billion. And our last slide going over the update to the valuation is just a table showing what would this look like in different oil price environments. So on the left, I've highlighted specifically what oil prices and natural gas prices were utilized for this analysis. The two tables on the right, the one on the top represents what the appraised value would look like in oil price environments moving up or moving down in $10 per barrel increments. And then the table to the bottom right represents what the undiscounted cash flow would look like in those same oil price assumptions. Because we can be very good at predicting how much oil is going to come out of the ground. We can utilize engineering analyses to be able to forecast these, but being able to forecast ultimately what oil prices are going to look like is significantly more difficult. So we like to be able to show this in varying oil price scenarios. So moving on to the next slide, this is kind of a shift from where we're going to be going over specifically the valuation to highlighting a couple of the trends that we've seen across the Bakken over the last year. Any questions regarding the valuation?
Just one quick one. If you go to page 134, I really like that, this graph. That's the one I kind of pay attention to that we talked about. And refresh me now, when you looked at your prior 4 or 5 years projections, has that moved, that 2035 date production starts to decline? Has that moved very much?
It has
been pretty consistent around mid 2030s. I think it's been pretty consistent, but
it's been relatively consistent. There has been some shift. Each year we go through and we reanalyze what is going on for trends within the development of, especially the areas where there's a lot of development yet to be done.
Mm-hmm.
The major change that we've seen, from really over the past few years, but becoming very prevalent this year is, when we first started looking at these in 2020, everybody was drilling 2-mile laterals, and these outside fringe areas of the Bakken really didn't look very likely to be developed. And I spent the majority of my engineering career believing that there were vast areas of the Bakken that would never be developed if oil prices weren't above $100 per barrel.
Sure.
Today, and over the last 3 years approximately, we've seen a lot of these areas where possibly there have not been wells drilled before, now being developed very consistently with the use of 3 and 4 mile laterals. So that has shifted a couple of things. Number one, it's making some of these outside areas a lot more attractive from an economic standpoint.
Sure.
So we're forecasting areas that had not previously been forecasted to be developed today. But it's also meaning that our overall well count is decreasing a little bit. If we're counting wells rather than lateral feet,
Sure.
If we're drilling 4 mile laterals.
Helpful proxy.
Yeah,
Sure.
exactly. Sure.
Well, the bottom end resilience of these wells continues to overperform.
Yes, absolutely, Mr. Governor. Thank you, Mr. Joe. Okay, moving on to the next slide, which is called expanding the core. This, expanding the core is a theme that we've been talking about at Mineral Tracker for a long time, and we're certainly not the only ones. If you go to any of the NDCC events or the Wilson Basin Petroleum Conference events, expanding the core has been a hot topic for a very long time, but it still continues to be one that I like to highlight because, like I said, early in my engineering career, there were a lot of these areas that I believed would be undeveloped for a long time. Today, they're being developed. And that is largely because of improved efficiencies, but especially because of 3 and 4 mile laterals, where you can reach an additional 50 or 100% of the rock you would normally reach with a single well, but you get to have a single surface location for that, the same set of tanks, the same pad, and all of that investment.
Huge.
It makes a massive difference. On the right is a map that has approximate boundaries for what we would call tier 1 for the core, tier 2 and tier 3 of the Williston Basin. The smaller white stars represent where 3 mile laterals are being drilled and where there are currently 3 mile laterals. If we had shown this graph 4 years ago, or if we had shown this map 4 years ago, the only place you would have seen this is under the lake in areas where you couldn't get to the minerals without drilling at least 3 miles to get there. Today, you see that they are really beginning to outline that tier 2 and that tier 3 acreage, which is how it's currently being developed. The slightly larger yellow stars represent where 4 mile laterals are either being, at the very least, permitted today, and several of them are being drilled. We have at least one right now that is producing and has some production history. We'll highlight that in the next slide. But everything that we're hearing is that it seems like we are very quickly going to have shifted from 2 mile laterals to 3 mile laterals, and 4 mile laterals is where we're going next. Pretty incredible. The last 2 years do represent the first 2 years that we've seen more development in the tier 2 and the tier 3 acreage than we've seen in the core. So why I'm always encouraged by this is that we, over the last 2 years, have been able to maintain flat production in North Dakota, even though we're not drilling in the best geology in the Williston Basin. And that seems like a trend that is going to continue for some time. some of the operators that have, really made their play about developing these outside areas are some fairly new players in the basin. Kraken at the top of this list actually came in about 2017, 2018 and began developing, but has continued to acquire more and more acreage and has been doing just a tremendous job with it. Phoenix operating drilled their first wells in 2024, but they have quickly become one of the most active operators in the Williston Basin. They've got 3 rigs today drilling in the Williston Basin. And then, a couple of these are familiar. Chord Energy being the combination of Whiting and Oasis, who has a great core position, but they're doing just tremendous work in these outside areas in the fringes now today. And Coda Resources is one that I always like to highlight. If you look at that swath of 3-mile laterals, the white stars in southwestern Divide County, this is an area that when we first put together this analysis, we did not anticipate any Bakken development back in 2020 in this area. Today, Coda Resources is drilling the area out and having a lot of success. On the next slide, I wanted to dive just a little bit deeper into the 1 4-mile lateral that the state has a royalty interest in that is currently producing. So in the map, you can see that we highlight this area in northern Montreal County, where the Rescheduled well was drilled last year by Chord Energy, their first 4-mile lateral in the basin. We looked at all of the wells in about a 5-mile radius of this Rescheduled well and looked at the average cumulative production from each one of these wells. And in the graph on the lower left shows how long it took each one of these classes between 2-mile laterals, 3-mile laterals, and this 1 4-mile lateral to reach 200,000 barrels of oil. And you can see the average 2-mile lateral in this area took 46 months to reach 200,000 barrels of oil. The average 3-mile was 22 months, and this one Rescheduled well reached 200,000 barrels of oil in 8 months. So the value proposition to go out to these areas and develop them with 4-mile laterals is pretty staggering. And last slide that I have for you on development trends in the Williston Basin. This is a little bit of a continuation of this same idea, but something I have not seen prior doing this analysis. We saw a tremendous uptick in leasing activity in oil and gas. I'm sure that everyone at this table is aware of how significantly higher the lease bonuses being pulled in over this last year have been compared to prior years. But the graph on the lower left illustrates that, showing that beginning in 2020 through 2024 typically was below $10 million in total. 2024 got above $10 million of lease bonuses being taken in through auction. And then in 2025, about $63 million worth of lease bonuses being taken in through auction. The map on the right illustrates in the red tracks where those 2025 leases were taken. So you can see it is a lot of these areas that aren't even really in what we would have considered tier 3 Bakken. They're a little bit further out from that in some of these areas. A lot in southern McKinsey, Billings, Stark County, on the northern side, northeastern Divide and Burke County. And these are all areas where, if we're looking at the operators who are taking these leases, many of them are the operators who have been developing the tier 2 and the tier 3 acreage. So one other thing that really isn't captured in the production profile that we spent some time talking about is, as operators continue to move even further out from what we would have called tier 2 and tier 3, we may see areas that we never would have thought being produced actually being developed. And you can see from the lease bonuses that are being paid in these areas, some of them are relatively close to the minimum, but a lot of these were really high lease bonuses as well. We saw the average lease bonus being paid in 2025 jump from $200 per acre in 24 up to over $800 per acre in 25. So these operators are really putting a capital commitment towards leasing this acreage, and that's a really strong indicator that they intend to do something with them. So, Mr. Governor, members of the board, that is the end of my presentation for you. I'd be happy to take any questions.
Question?
Been asking them as we go, so thank you.
You get everything you need from us?
Yes, I've been able to work with Chris and with Joe. Part of the benefit of having done this for the last 6 years is that we've got a very well-established database of the state's minerals. So the demand on Chris and Joe has decreased over time as we've just been able to continue to work from that robust data set. But yes, we're getting everything that we need.
I'll just say I've been through this presentation now 3 times, and this is always my favorite board meeting. I always learn something that I hadn't considered moving forward, and it makes me excited for the future. And thank you, Catherine. Thank you, Joel, for putting this together. This was awesome.
Thank you, Mr. Secretary. I very much appreciate that.
Okay, one more new guy question.
Sure.
What's dry? I mean, I know enough to be dangerous on the economics of oil, but that's a dramatic increase in total bonuses. Is that a result of these longer laterals that's changing economic decisions, or I don't know much about the bonus structure when it comes to leasing?
Yeah, I mean, it's a little surprising, and a lot of it can be tied to the price of oil.
Sure.
But also, like here, it's like Joel said, the technology has gotten there to where the acreage that was, with 2 mile laterals, you weren't seeing the rate of return. Everything in oil, just like it is in business, is rate of return, what they're going to get out of this. I think that illustration where he showed what that 4 mile lateral was doing with the 200,000 barrels that quickly has then increased the interest in all of this tier 2, tier 3 acreage. And the rate of return on the payment of those means that acreage is now way more valuable than they previously thought in the past.
This is an economic metric of what that technological innovation is going to be.
Yep. We're seeing all sorts of different, and I actually think that, like, you're right, and we talked about this a little bit. Rather than wells, it's almost going to be lateral feet drilled now, because your measurements are going to be a little bit off going forward. They do that in Texas a lot, where they're valuing lateral feet rather than the well perspective. I mean, there's caveats to that, but yeah, you're seeing this just continue to expand with because the capital commitment is less, and you're getting more out of a 3 or 4 mile lateral in your rate of return, because you just don't have to spend as much money. You don't have to, the development costs go down, and the rate of return has obviously been good. But that's what's driving that competition for acreage. Plus, we've seen, like you said, some new players. Some private equity money is going after and now being operators.
Sure.
So that competition's nice to have in there.
Yeah, maybe if I could just add to that, from my conversations with operators, the moved 4 mile laterals has really expanded the areas that they would consider developing.
Sure.
So as you expand the area that you're considering developing, a lot of this acreage, may have been leased back in the early 2000s, maybe not, and since expired because they didn't believe that they could drill an economic well in this area. So, I look at some of this in Southern McKenzie, for instance, and it was highlighted for me, shortly after the auction happened, what lease bonuses were paid for some of these tracts, and just about fell off my chair because I never would have expected that this particular tract would have gone for this price.
Sure.
But there was competition in this area. So you had at least 2 operators that believed that they could go and drill an economic well using likely 4 mile laterals in an area that for the last maybe 10 years had never been leased.
Ignored. Sure.
Yeah. I mean, the differences be like $2 to $20 an acre to $1,400 an acre. That's the
Even at $58 oil, you pay more for a lease if you're paying off the well in 8 to 10 months versus 46 months. Particularly if you look at the list of the companies who are doing it, I mean, cash flow is their problem.
Right.
It's not necessarily cumulative oil; it's cash flow is their problem. So if they can pay off a well in 8 months, they can drill more wells. If they're waiting for 46 months to pay out their well, then paying high bonus structure because they're all 5-year leases, they don't have the capacity to move themselves through that space as quickly. And now, which just breeds competition, which brings up the price of the lease.
Right. What's enabled technologically these, laterals doubling?
They just get better at doing it, and the regulatory, from our end, what helped was the lake. Because we started doing 3-mile spacings, and then all of a sudden comes back and, and on DMR and the Industrial Commission, economics is part of this equation. When you decide how to do it, once you can prove one up and don't get out of it. But I'm assuming that's why you use 200,000 barrels in the 22 months, 8 months, and 46 months, because generally speaking, that's probably payout. Pretty close, right? It's 9.6. $58 oil, 10% off bonuses. So you're running right around payout time on 200,000. Sure.
Well, the kids leave by.
Every dollar.
It sure is. Yeah. Yeah, you set the bar high for the first meeting. I hope to learn this much every time we sit down.
Good. All right. Well, thank you, Mr. Governor, members of the board. Thank you.
Thank you.
Hopefully you make that Washburn okay today.
We'll see. I hope so.
Worst.
Yes. All right. Getting to the end of the regular agenda, so we'll go down to item 6, the litigation update. First case is the MHA versus United States Department of Interior. Do not have any new updates on that. The other side summary judgment motion has been sitting in front of that judge since April. So we're still waiting to hear on that. Federal judges, I guess, work on their own timeline. So.
Correct.
The Leland case at the bottom, we updated last time that we filed a joint appeal on that case with Department of Water Resources to the North Dakota Supreme Court. Both parties are now doing their briefing, and briefing on that will be completed in January. So nothing real update there, except the lawyers are working on the briefing. So any questions on that? Any questions on anything else that we covered today? Well, we do have an issue to talk about in executive session. So
we're going to take a 3-minute break. You want to do it before we go in or right after how about we do it while we're switching?
We can do the break before, or it's up to you.
Well, we got to switch over all the calls and everything anyways. So that doesn't seem a terrible time. Go in and then.
So we have a recommended motion.
Under the authority of North Dakota Century Code sections 44-04, 19.1 and 44-04, 19.2, recommend the board close the meeting to the public and go into executive session for purposes of attorney consultation regarding royalty settlements.
Second.
Discussion. Roll call.
Secretary Hall.
Yes.
Superintendent Lockmeyer.
Yes.
Treasurer Beadle.
Yes.
Attorney General Wrigley.
Yes, I'm not sure how I'm going to jump on there. I don't think I have another link for it, but you guys might have to just put me on a phone.
We can't hear you.
Can you hear me now?
We can hear you, Drew.
Yes.
Okay. Yeah. All right. Okay.
I'll
I mean,
use
will but just stay on this link and I'll go into the executive with you, or do I have to get onto a different link?
There was a different link sent, but if you can't find it, we can call you just on your phone.
Just give me a call. Just give me a call.
This executive set. Oh, we got to take roll call. Or we just did.
Yep, we did. Yeah.
Yep.
Good job. You filled in for Drew very well.
It's team effort.
This executive session is recorded, and all board members are reminded that discussion during executive session must be limited to the announced purpose for the entering into executive session which is anticipated to last approximately 20 minutes. Board members, their staff, employees of Department of Trust Lands, and counsel with the Attorney General staff will remain, but the public is asked to leave the room. The executive session will begin at 10:40 a.m. and will commence with a new audio recording device. When the executive session ends, the board will reconvene in open session. Whole meeting? Coffee's been
Locked-
empty for the whole
Locked
meeting.
into that
though.
one.
Yeah. I was like, that probably wasn't the first.
All right. Executive, are we ready?
Ready, Caitlin?
Yep, we're open.
All right, the executive session has adjourned and the public has been invited into the meeting room. The board is back in an open session. During executive session, the board consulted with its attorneys regarding the identified legal issue. No final action will be taken as this time as a result of the executive session. We do not need a motion or a vote because we took no action. So with that, any updates on your travel schedule? Your meetings?
My son is graduating from college tomorrow.
Congratulations.
He's a December grad. So,
Is that early or late?
no, he graduated in 3.5 years.
He knows college is not a race, right? My first
He
junior.
had he had some college credits from high school. So he's graduating from Grand Canyon University in Virginia. So I'm supposed to be trying to get down there for kids.
All right, well, let's adjourn so you can go.
Thanks, everyone. Safe travels, Joe.